Thinking of buying your first home? You've got two powerful tools to help you save: the RRSP Home Buyers Plan and the First Home Savings Account, or FHSA. Let's explore how they work and how they can help you reach your goal. Both are government programs that help first-time home buyers save money and reduce taxes, but they work differently. First, the Home Buyers Plan, or HBP, lets you withdraw up to $60,000 from your RRSP, your Registered Retirement Savings Plan, tax-free to buy your first home. You're essentially borrowing from yourself, and you have 15 years to pay it back. Repayments normally begin 2 years after you make a withdrawal, and each year you repay 1/15 of what you withdrew. To repay, simply contribute the amount owed to your RRSP in the year it's due or within the first 60 days of the next year. If you don't repay the required amount, that year's amount is added to your taxable income. Next up is the FHSA, or the First Home Savings Account. It's a separate savings account designed primarily for buying a home. You can contribute up to $8,000 per year, up to a lifetime limit of $40,000. Just like an RRSP, the money you put in is tax deductible, so it can help lower your income tax. You can invest it, and the money could grow without being taxed. When you're ready to buy a house and meet all the conditions, you can withdraw both your contributions and any growth tax-free. Even better, unlike the RRSP, you don't have to pay it back. Finally, if you don't use your FHSA, you can transfer it into your RRSP without affecting your contribution room if it's a direct transfer and within the FHSA limit. In summary, the HBP gives you access to up to $60,000 from your RRSP. Withdrawals are tax-free if repaid on time, and you benefit from flexible repayment over 15 years. For the FHSA, you can contribute up to $40,000 over your lifetime. Withdrawals are tax-free if you meet all conditions, and no repayment is required. Which one should you choose? Here's the best part. You can use both the FHSA and the HBP for the same home purchase. That means you could access up to $100,000 in tax advantage savings, plus any investment growth from your FHSA, which could give your down payment a serious boost. Who can open these accounts? To open an FHSA, you must be a Canadian resident, be at least 18 years old, be a first-time home buyer, which means you didn't live in a home you, your spouse, or common-law partner owned as your main residence in the past 4 years. To use the HBP, you must have an RRSP with enough savings to make withdrawals, be a first-time home buyer and Canadian resident, show you have a written agreement to buy or build a home that you'll use as your main residence within 1 year. Whether you're saving with the FHSA, borrowing from your RRSP with the HBP, or doing both, you've got great options to make your first home a reality. Want to learn more? Talk to one of our licensed advisors or visit the Canada Revenue Agency website for more details on these plans.